Good morning, this is Craig Moddelmog with this week's version of Wall Street X's and O's. Today is Wednesday, October 10th. Hard to believe we are already into October, but to add my quick disclaimer here or disclosure, everything commented on this video cast is not a request to buy or sell anything. All products can lose value, and in many cases will. They are not FDIC insured, nor are they guaranteed. So anyway, as you can see, I'm getting better at delivering that disclosure, of which I'm not a big disclosure fan, but it is necessary. So anyway, quick historical note. As of today, in 1953, the New York Stock Exchange, actually this is as of yesterday, traded only 900,000 shares. This was 1953. On average today, the New York Stock Exchange trades anywhere from 2 to 6 billion. That's with a B. Big difference since 1993. Moving on here, I read an article recently talking about the amount of money in money markets. They said 3.4 trillion reasons why the market is going up. What I find interesting is if you look back historically, back to the early 80s, funds in money market relative to the market value. Okay, so this is the total value of the stock and bond market. There's only been a few times when this has been really a true case. One being in the early 80s where the money market value totaled 23% of the entire stock and bond market value. Back in the early 90s, 19.6%. During the tech wreck, 23.9% in money market. And during the financial crisis, the end of 08, beginning of 09, 46.9% of all assets were in money markets. So I would look at today saying I disagree with that, in that there's not enough in money markets to really deem a really big move in the markets to move forward. So I'm going to kind of call the full bull on that one, but I guess who knows, and we shall see. Moving on to earnings. We're getting ready to enter in the third quarter, of which earnings are very important. As you know, I talk a lot about keeping your eye on the ball being the fundamentals or the numbers within the markets. As we get ready to see what the third quarter is going to offer, Ned Davis Research, who is one of my go-tos when it comes to fundamental and technical research, they said going back to 1953, they have tracked earnings declines, and there have been 17 times where their earnings model has entered bearish territory. This is, again, going back to 1953. Of those 17 times, 4 of them did not result in a recession. Will this time be any different? I don't know. Obviously, time will tell. I think the next 6 to 9 months are very critical as we look at the market, we look at earnings, because right now, the market is really calling for an earnings re-acceleration. This means earnings growth starting in the third quarter of 2019. That is now, people. So needless to say, eye on the ball is Q3 earnings. Watch them closely, because that is really going to dictate a lot of what to anticipate in the markets. Should we see a reacceleration? Right now, the market's calling for growth of around 11.7 as we move into 2020. I think we see the markets kind of limp along and probably limp higher. Should we not get any type of reacceleration and we see continued deceleration, you need to keep your eyes on that, because the stock market value, that meaning stock prices, will be forced to readjust, and that does not mean higher. That will be a readjustment lower. How do we combat that? We combat that with really good, solid asset allocation. Right now, I am really focusing on high quality, both on the bond side as well on the stock side. That is how you combat market volatility. We also combat that with weightings. Are we overweight? Are we underweight equities versus bonds? Right now, I'm very equal weight on the equity side. I'm not too excited. I'm not too negative. Time will tell, and I think we're going to see that start to take shape here very soon. So again, for this Wednesday morning in October on the 10th, I wish you all a wonderful rest of your week, And this is Craig Moddelmog at Cornerstone Wealth Management. And for Wall Street X's and O's this week, I am out.